For thousands of years, gold has represented wealth. Empires stored it. Kings fought wars over it. And during economic crises, investors still rush toward it. Even in a world dominated by digital money, stocks, and cryptocurrencies, gold and other precious metals remain some of the most trusted assets on Earth. But investing in precious metals today looks very different from simply buying gold coins and locking them in a safe. Modern investors have multiple ways to gain exposure to metals like gold, silver, platinum, and palladium. Each approach comes with its own benefits, risks, and strategies. So why do investors still turn to precious metals? And how can someone actually invest in them today? Let's break it down. Precious metals occupy a unique place in the financial world. Unlike stocks or bonds, they are physical resources that must be mined from the earth. Unlike currencies, they cannot simply be printed or created by governments. This scarcity is one of the reasons they have retained value for centuries. Investors often view precious metals as a form of financial protection. When inflation rises, currencies weaken, or markets become unstable, demand for metals like gold tends to increase. This is why gold is often called a safe haven asset. But investing in precious metals isn't only about protecting wealth during crises. Many investors include metals in their portfolios as a long-term diversification strategy. Understanding how these markets work is the first step before making any investment decisions. Why gold is the most popular metal? Gold dominates the precious metals market. Central banks around the world hold thousands of tons of gold as part of their financial reserves. Governments trust it because it is durable, scarce, and globally recognized as valuable. Unlike many other commodities, gold is rarely consumed or destroyed. Most of the gold ever mined still exists in some form today. This limited supply growth helps support its long-term value. Gold also tends to attract attention during economic uncertainty. When inflation rises or stock markets become volatile, investors often move money into gold as a way to preserve purchasing power. This behavior has repeated throughout financial history. Silver, the industrial metal. Silver is another popular precious metal for investors. While it shares some similarities with gold, silver has a much larger role in industrial production. It is widely used in electronics, solar panels, batteries, and medical equipment. Because of this, silver prices are influenced by both investment demand and industrial activity. When manufacturing and technology industries grow, demand for silver often increases. However, this dual role can also make silver more volatile than gold. Prices may rise quickly during economic growth but fall during slowdowns in industrial demand. Platinum and palladium. Platinum and palladium are less well known but still important precious metals. Both are heavily used in automotive manufacturing, particularly in catalytic converters that reduce vehicle emissions. Because their supply is limited and geographically concentrated, disruptions in mining regions can cause price spikes. Automotive industry trends also influence demand. For example, changes in emission regulations or shifts toward electric vehicles can impact the need for these metals. Investors sometimes include platinum or palladium in portfolios as a way to diversify within the precious metals category. Different ways to invest in precious metals. One of the biggest advantages of modern markets is the variety of ways investors can gain exposure to precious metals. The most traditional approach is buying physical metals. This includes gold bars, coins, or silver bullion. Physical ownership gives investors direct control over their assets. However, it also introduces practical considerations such as storage, insurance, and security. Another popular method is exchange-traded funds, often called ETFs. These funds track the price of metals like gold or silver and trade on stock exchanges just like regular shares. ETFs allow investors to gain exposure to metal prices without storing physical bullion. Futures contracts are another option used mainly by experienced traders. These contracts allow investors to buy or sell metals at predetermined prices on future dates. Futures markets are highly liquid, but also involve significant risk because they often use leverage. Mining stocks offer a different type of exposure. Instead of buying the metal itself, investors purchase shares in companies that mine and produce precious metals. When metal prices rise, mining companies may become more profitable. However, mining stocks are also affected by operational costs, management decisions, and geopolitical risks. What drives metal prices? Precious metal prices are influenced by several major economic factors. One of the most significant is inflation. When inflation rises and the purchasing power of currency declines, investors often turn to gold and silver as a store of value. Interest rates also play a critical role. Precious metals do not produce income like stocks or bonds. When interest rates rise, income-producing assets become more attractive compared to metals. But when rates fall, the opportunity cost of holding metals decreases. Currency movements are another important factor. Gold is typically priced in US dollars. When the dollar weakens, gold often rises because it becomes cheaper for international buyers. Geopolitical uncertainty can also trigger strong demand. During wars, political instability, or financial crises, investors frequently seek the security of precious metals. Finally, supply and demand dynamics influence prices. Mining production levels, industrial consumption, and central bank purchases all contribute to market fluctuations. The role of precious metals in a portfolio. Many investors do not treat precious metals as primary investments. Instead, they use them as part of a diversified portfolio. Diversification means spreading investments across different asset types to reduce overall risk. Because precious metals often behave differently from stocks and bonds, they can help balance a portfolio during market downturns. For example, when stock markets decline, gold sometimes rises or holds its value. This does not happen in every situation, but historically metals have often provided some protection during periods of economic stress. Financial advisors often recommend modest allocations to precious metals rather than heavy concentration. The goal is stability rather than speculation. Investing in gold and other precious metals combines ancient value with modern financial strategies. From physical coins to ETFs and mining stocks, investors now have multiple ways to participate in these markets. Precious metals can offer diversification, potential protection during economic uncertainty, and exposure to global supply and demand dynamics. But like any investment, they require careful consideration and a long-term perspective. Understanding why metals move, how they fit into a portfolio, and what risks they carry is essential before investing. If you found this breakdown helpful, hit the like button so more people can discover it. Subscribe for more insights about investing, financial markets, and strategies that help people protect and grow their wealth. And remember, gold may be ancient, but its role in modern investing is far from over.